to you by BDO Australia. In our webinar today, we'll be taking a look at capital markets, specifically public capital markets and the ASX. My name is Tim Aman. I'm BDO's Global Fintech Leader, as well as our National Financial Services Leader. Before we kick things off, I'd like to just quickly draw your attention to the housekeeping slide that is currently showing on your screen. To start, you are all automatically muted, but we'll be accepting questions throughout the session, and you can submit these using the question tab. We will try to get to as many questions as possible. However, if we cannot respond to your question, we'll follow up with you after the webinar concludes. If you are experiencing any technical difficulties, please click the support button, which is one of the bottom tabs on your screen. And finally, the session is being recorded, and all registrants will receive a follow-up email containing the slides, a link to the recording, access to register for future sessions, and the speaker contact details for all of us. For Fintechs, access to capital remains a critical component to their success. With a myriad of changes occurring, specifically COVID over this past year, what are Fintechs' funding prospects for 2021, and how do they tap into the public capital market, and what's the best process for an IPO? I'm very happy to have on the panel today Josh Collard, Listings Business Development Manager at the ASX. Josh is responsible for the development of ASX domestic and international listing business, working with companies across industry sectors and help them raise capital to fund their growth ambitions via the ASX. I'm also joined by Sebastian Stevens. Seb is the partner in charge of BDO's Sydney's corporate finance and advisory team, our national leader for private equity, and Sydney's leader for TMT. Welcome, both of you.
Thank you.
Before we begin, it'd be good to get a sense of what the sources of capital that we expect our audience to be looking to seek next year. So we'll have our first polling question. And the polling question is, if you are looking to raise capital in the next 12 months, what sources are you considering? Friends, family, and fools, venture capital, private equity, mergers, acquisitions, strategic alliance, and IPOs. Seb, any predictions on what you think the answer would be?
Venture capital.
Josh, you're hoping IPO?
I'm hoping IPOs. You guys know your audience better than me, but I'm hoping for IPOs.
And as the poll's coming through, probably just a sort of a quick comment on a lot of my sort of fintech clients. They're in probably the friends and family sort of sort. And probably what I saw with a lot of my clients, if they were able to raise capital sort of pre-March, they were in a very good position. Those that were struggling to raise capital probably when COVID hit are probably looking for turning the page on COVID and looking into 2021. So hopefully we'll get a lot of questions today. Any responses?
Right here at venture capital.
Yeah. So, okay, thank you for responding. No VC people out there. So, so maybe what we'll do is we'll just kick off before we get to the slide presentation, just in terms of a few questions. And so that slide, obviously, that the results sort of showed VC isn't being relied upon, but probably over the last sort of 15 years, VC and PE investors have been our primary source of raising capital, but the IPO activity, Seb, has been the busiest for tech companies on the ASX since the last 15 years. Why do you think the source of funding has been changing?
Yeah, look, I'm not sure it's changing. I think there's always a big venture capital and private equity market. I think what's changed for public markets is that there's just that acceptance now that that tech is a genuine sector. I think the other thing that's happened or evolved over the years is that the Australian investing public has always been receptive to entrepreneurial stocks. I mean, the ASX, and Josh knows better than I would, sort of was built on entrepreneurs, mining, speculators, that sort of thing. So I think tech works pretty well for them. I think we're a little bit more accepting of those type of investments in Australia. So yeah, I think it's that evolving nature of acceptance by the public markets.
Okay. And in terms of what size of companies are you seeing listing?
Yeah, specifically tech. There's a range. Obviously, you're always going to find a range. I think the sweet spot that we're sort of seeing where they're actually doing well is somewhere between sort of 150 and 500 million. Obviously, there's outliers on both sides of that, but that's where we really are seeing real appetite and real growth prospects.
Okay. Josh, in terms of the geopolitical backdrop, do you think that's affecting Australia's capital markets?
If we're talking about capital into the market, I don't think personally I've seen or heard anything that sort of indicates it has. I think one of the things we're really fortunate here in Australia is to have the luxury of a very, very deep pension pool. It's just shy of $3 trillion. Everyone's superannuation obviously gets paid into that, and that's really a buffer for the capital markets, and really the secret source of what makes us punch, well above our weight here in Australia in good times and in bad. And you mentioned obviously COVID at the start of the year. Everything fell off a cliff in March. Companies very quickly, good companies through no fault of their own, went from revenue projections that were very stable to almost being in distress. And we saw serious amounts of capital being raised, be it for short-term liquidity needs, shoring up a balance sheet, or those that were fortunate enough to benefit from growth capital. And the market was there to support them. So I think from a capital perspective, I don't think there's anything anecdotally that I've seen that would say otherwise. But if we look at sort of various geopolitical challenges around the world, there's certainly been reaction in the commodity price space. The gold prices has had a bit of a run this year with a flight to safety for various reasons, but it's come off a little bit now. Off the back of that, we saw the junior resource section emerge again, which is not relevant to this audience, but as an exchange, it's pleasing to see. And equally, steel and iron ore prices off the back of the Chinese recovery, and in the iron ore space, issues in Brazil. We've certainly seen moves in that price that have impacted the market as well. So look, overall, I don't think there's been a massive impact yet, but we are fortunate in a very, very deep capital market.
Okay, thanks. And I guess specifically for fintechs in 2021, what's your sense of funding prospects for this sector?
Well, I think the funding prospects, for all companies, but particularly those in the tech space, really have never been better. I mean, there's lots of options now domestically here in Australia in private capital. There's lots of dry powder on the sidelines. Equally, the public markets that we've seen in this second half of the year has been very, very receptive to IPO activity, from a lot of different sectors, but particularly the tech sector has seen a boom in companies in the second half. And I think what's really aided tech companies has been the outperformance that we've seen from that sector, not just this year, it's really just consolidated it, but over a number of years, outperforming benchmark indices, and that's made investors excited and want to make sure that they sort of get on, the next big thing, so to speak. So I think, for tech companies, conditions are really good for those that are out there looking to raise capital. And I think from an investor's perspective, when you've got rates at basically zero, it actually forces people, to hunt for alpha. And the outperformance has been in tech. So all those things line up well.
Okay. And so just before you kick off your slide presentation, I guess, and I think you'll cover this in your slides, but how active is the public capital market in Australia? And more specifically, if you can just provide us an overview of the tech space.
Yeah, look, I think maybe it's worth just jumping into the slides, so I'll cover off a fair bit of that. But the bottom line really is in Australia, we have an extremely active capital market. And first slide here gives a little bit of an overview of ASX. Let's see if it comes up. There we go. So, I appreciate a lot of people know of ASX, but it's always worth sort of sharing a few sort of fun facts or stats about the exchange. And on any given day, we do about $8 billion of equity volume. We do around 120 new listings annually, backed by the fourth largest pension system on earth, which is that $3 trillion fund that I spoke about. 2,200 listed companies. Resources, no surprising, is the largest sector. But actually our second largest sector is technology now, and that is where we're seeing all the growth. So that's really exciting for us. And in terms of the actual market itself, we do about $8 billion of IPO capital on an annualized basis, and we do about $40 billion in follow-on capital annually. So I spoke a little bit in the preamble about the superannuation sector, and this sort of just shows where we sit in the world. Fourth largest, as I said, but what's really exciting and a great problem for everyone in this country to have is that the pool is forecast to grow to $10 trillion in the next 15 years. And all that money needs to find a home. A lot of that money does make its way towards the ASX through mandate. So it actually forces us, to continually be out there looking for fresh IPO activity. It's driven us overseas as well. You see, a number of international listings coming down to Australia, and that's really, the size of the pie is getting bigger. We need to grow and make sure we keep up with that. So a little bit of a recap of the year that we had. So no surprise to anyone, COVID-19 obviously had a massive impact in the IPO market globally in the first half of this year. And this slide, there's a bit of detail here, but the light blue bar shows IPO activity in 2019. ASX was the third most active exchange globally in 2019, excuse me. And the first half of the year, we saw very limited IPO activity, really, all over the world, and we weren't immune to that. But what we've seen, particularly in the North American markets, in the second half of the year, is just a massive resurgence in IPO activity. But it's interesting to note in the US, there's been a lot of activity in SPACs, and we currently don't allow SPACs, or cash boxes as we call them here in Australia, but around 50% of the issuance there out of the US has actually been SPAC activity. In Australia, we've equally had a massive tailwind of IPOs. So you can see there, we're up well over 100% as well on the prior corresponding period. This slide's a couple of days old. We've just pushed through. I think yesterday we had our 93rd listing for the calendar year. So we've outdone last year's numbers, which is a pretty phenomenal feat when you consider where we and the rest of the world was, 6 months ago. So people obviously talk a lot about IPOs, and that's what gets all the headlines. But actually, what's really important about a well-functioning market is the efficiency of raising follow-on funds. And Seb mentioned sort of the sweet spot of companies in the technology space that are listing $100 to $500 million. These companies are raising growth rounds on ASX, and they're going to need more than likely future growth capital. And one of the great things about being listed is the ability to raise that and raise it quickly. So you can do a placement in as little as 48 hours or sooner. And by number of secondary offerings, ASX has done the most globally this year. But even by capital raise, I think we're at about $55 billion of issuance this year in the secondary capital market. So, that period from March through to August, we did about 12 months of issuance in 6. So it's been a phenomenal year. Around 500 companies raised during that period as well, so almost a quarter of listed companies. In the tech sector, most of the raises have actually been for growth opportunities. There are a few businesses that obviously have been impacted, but as a general statement, we've seen raises from the tech sector more often than not being beneficiaries of this year, actually raising for growth purposes. So a bit of a summary of the listed market on ASX. The graph there on the left sort of shows the growth of the sector over the past sort of 6 or 7 years. We've listed around 100 tech companies in the last 5 years, done about $4 billion of IPO capital for those. With a new float last week, that's probably closer to 5 now. But what's really pleasing to see is the maturation of the sector. So you can see on that left-hand graph, 2014, 2015, about $50 billion of market cap. It's now $180 billion of market cap. It's grown phenomenally. Fastest growing sector, as I said, second largest sector. And what a lot of people aren't aware of is the fact that actually we've got 30 listed tech companies on ASX that are actually worth more than $1 billion. So there are some large businesses listed on ASX, and the total sort of universe of tech companies, depending on how you cut it, are about 260, 270 companies. So again, just comparing where we sit in the world with our peers, fourth most active exchange globally over the last 5 years by number of tech IPOs. If you look at who's in front of us, Japan is a pretty domestic market. Hong Kong has a lot of mainland Chinese listings. So, if we're talking about sort of Western markets, if you like, it's only NASDAQ has actually done more listings than ASX over the last 4 or 5 years. So, we're very fortunate to have a very, very active sector here in Australia and investors that are looking to back it. Just looking a little bit closer at 2020, these are all the tech IPOs by year to date. I've sort of put a box around those that we would consider to be fintech companies. But there's been 17 tech IPOs this year, headlined by Nuix last week, which raised just shy of $1 billion. But as you can see here, various types of raises from a couple of $100 million, through to sort of early stage and growth capital. A couple of Kiwi companies down the bottom right there who did foreign exempt listings. Zebit is a US company that I know you guys worked closely with on their float, but almost all of these listings exclusively have been in the second half. So we've seen a real resurgence of not just tech, but the IPO market as things have sort of eased here in Australia. Do you want to speak to Zebit?
The point I probably should make about Zebit is that one, it's a fintech stock, so that's kind of appropriate. I think the second is that it sort of reinforces what you were saying beforehand about the international listings. So we've sort of gone on a bit of a pathway, I suppose you'd call it, over the last 4 or 5 years, focusing on US tech stocks. We feel like we gave the ASX the idea about going to the USA. So we've done that quite successfully, and I think Zebit was a really good example of where, in the midst of COVID, it's a business that actually focuses on the financially challenged market in the US. It's brilliantly run. It's actually, there's some impressive management team there. It's come across to Australia. It's actually done reasonably well. I think the proof of the pudding will be a bit later on. But I think it's a good example of what the ASX can do. And I think that's something we probably should focus on here, is that you've spoken about NASDAQ, and NASDAQ does more listings. But if you're a tech company in the US, NASDAQ is a long way away, I would have thought you'd say. One of the attractions of the ASX is you can come here, similar valuations to the next round of VC that you're probably going to get in the US. You can get onto a global exchange, you get liquidity, you get credibility. And I think that's a real key differentiator. So I don't know what your thoughts are on that, but I think to get on an S&P index for NASDAQ now is 35 billion or something.
NASDAQ, yeah, it's quite high. Yeah, and even the S&P's, I think $8 billion.
Yeah. So
well, it's an interesting one, because I think a few of my clients, they consider going to the US. I think there's still that natural, obviously I'm American, so I can say this, but there's a natural attraction to going to list in New York. But I think what people have to understand is they can list here, and given how active the market is and the access to capital, they should really probably sort of reconsider that. So I think that was probably part of the reason you guys did your roadshow, in the first place. But maybe if you just talk a little bit about the roadshow in terms of maybe how successful that was, and I guess plans, for 2021, sort of COVID dependent in terms of potential roadshows.
Yeah, I think sort of if we talk about US companies, but it's equally important for domestic companies here to, who have visions to go and list in the US potentially. It's as Seb said, it's a very, very long road to get there. I spend and Seb spends a fair bit of time pre-COVID in the United States, particularly around Silicon Valley and dealing with VC and pitching to companies directly and educating people about ASX. The main challenge you've got in the US is that the public markets there at the moment really are mega cap IPOs / exits. And the markets in Australia, we're very fortunate we still have a small, a mid and a large cap market where you can go and raise growth capital. And so, yes, the US markets are the deepest and most liquid capital markets on earth, but the Australian market is extremely robust. And considering the size of our population, we punch way above our weight. And for a company that's looking for a growth round, let's say $100 million, you go and try to do that in the United States, it's pretty tough to get attention. In Australia, if you're raising $100 million, the blue chip bulge bracket banks, will be very interested in what you're doing. It's a classic, small fish in a big pond mentality. You come here, you get attention, which is why, we're seeing sort of mid-cap style US companies come down here and raising capital as an alternative to further private financing. A lot of these companies are too small still to go list in the US. General consensus is about 100 mil US of ARR to start thinking about a US public market listing, but also the cost of listing over there is substantial with, the additional compliance burdens, etc. So, we educate people about the Aussie market, about the power of the Aussie market. Local investors are really interested in growth stories, as Seb said, we've grown up, on the resources industry, and that continues to this day. But the mentality there of people being prepared to take some risk on it is much higher than in a lot of other markets. And the key thing is that passive money. So Seb mentioned about getting into the S&P 500 and the NASDAQ composite indexes. You need to be, in the case of the NASDAQ, tens of billions of dollars to get into it. To get into the ASX 300, you need to have $300 million of free float market capitalization. And those same investors in the US are active here in Australia because of that pension pool. So the argument is you're going to get that passive money much, much earlier here in Australia.
Okay. And in terms of roadshows, in terms of 2021, what are your plans for roadshows?
Yeah, look, I mean, the minute we're allowed to, I mean, we'd love to get out on the road again on an international front. We've started moving around a little bit domestically again now. I think we're all beholden to what the government says, really. And Zoom is great, but there's nothing like burning the shoe leather. So, we'd love to be over in the US as soon as we can, but there's other markets that we sort of focus on. New Zealand, Singapore, Israel are sort of our key 4 international markets. But I suppose the beneficiary of COVID has actually made us, turn inward more and actually look at what's in our own backyard. And there's some really impressive stories domestically here in Australia. So even if we can't get out internationally, there'll be lots of road showing going on domestically here too.
Yeah. So just before we move off a little bit in terms of, obviously, buy now, pay later has been very topical, sort of a darling in the stock market with Afterpay, Klarna, etc. Do you think are we at capacity for buy now, pay laters, or do we think it's going to be a continuing trend for 2021, more entrants to the market?
You want to take it?
No, I think you should take it.
Look, it's a hard question to answer. I think when you've got an incumbent that has done so well, there'll be plenty, of others, and there's more than one incumbent that's done well. There's several, but there's plenty of others that will be looking to take their lunch. And we're still seeing, we're getting, buy now, pay later inquiries. There's been a couple listed this year. There's a couple more in the pipe. Whether there's room for all of them, or some consolidation needs to take place, I think time will tell. But the penetration in big markets like the US is still very low. So there's plenty of headroom left, and it's just a question of who can get there fastest.
It's an interesting topic because from a global perspective, I'm part of the global fintech group, and you look at I look at there's a great opportunity for Australian companies to go overseas, just in terms of some of the great ideas that we're seeing in Stone and Chalk, et cetera, and the innovation hubs. And you look at South America, they're a very underbanked sort of country or continent. And so do you have any views in terms of what do you think from a fintech perspective that might be more transferable to developing countries?
I mean, we see sort of early stage opportunities, ignoring South America for a moment, actually a little bit closer to home. You look at places like Indonesia, the Philippines, that Southeast Asian region, and to your point, the unbanked market, yet everyone's got a mobile phone. And there's a lot of technology businesses, set up in Singapore that are looking to sort of tap into that area. And we haven't seen one yet, to my knowledge, sort of out in the ASX market, but we have spoken to a few sort of emerging companies up there, and I think that sort of serving the underbanked market, which is a significant market, is a massive growth story, and I wouldn't be surprised if we do see some of these things start to unearth themselves over the next couple of years.
Okay.
So I think looking at sort of what have been the real drivers of the tech sector over the last few years, unquestionably it's been the wax stocks, as the media have coined them: WiseTech, Afterpay, Appen, Altium, and Xero. Massive outperformance, excited the market, brought a lot of new investors into the technology sector, and you can see here the returns since IPO. I mean, Afterpay's return is nearly 10,000%. Xero listed on ASX in 2012, but it was actually listed in New Zealand 5 years prior to that. And I mean, if you take into account from the day it first listed in New Zealand, I mean, their performance is well over 10,000%. So people who have got into these early and stayed the course have done phenomenally well, and that's what's really excited people. Looking at the right hand side here, what's pleasing for us as an exchange, I mentioned it before, is sort of the maturation of the sector, and you're seeing large licks of follow-on capital being raised. Over the right hand side here are sort of the top 5, and almost all of these bar one there have been for growth purposes, which is really pleasing to see, and the market has supported it. And some of these have been done for those that are chasing true growth, at some of the tightest discounts that we saw during that window. So it's very, very pleasing to see. We've touched on the international listing, so I'm not going to go through this too much, but I think maybe just to explain to people sort of why we target certain markets. And if you ignore the US here for a second and you look at New Zealand, Israel, and Singapore, the reason why we like those markets is because from a domestic capacity perspective, it's a very small addressable market, and it's a relatively small capital market. So founders in those jurisdictions generally have to look outside their borders from day one. So they're quite receptive to international opportunities. And the US is the inverse problem. Massive addressable market, massive capital market, but a public capital market that's really only available for very, very large cap opportunities. And so what we're going after there are growth capital rounds, alternative to latter stage VC, private financing, etc. But equally for those that are sort of early backers or private financiers, opportunities to realize liquidity at an earlier stage than what you were originally thinking if you were on a public markets trajectory, or as an alternative to a trade sale. So what's really accumulated this year over the last sort of 5 years of growth in the tech sector here in Australia is the fact that we managed to have enough of a critical mass to launch the All Tech Index. And it's an S&P index. It's actually getting rebalanced for the third or fourth time after close today. So hopefully we'll see a few more go in there. It was launched in February this year, right at the top of the market, unbeknownst to us. We had 46 foundation constituent members in that, 100 billion market cap. These stats on here as of the last rebalance in September, 140 billion market cap. It's about 160 billion now, and there's 58 companies in that. And what's really pleasing to see, one, the massive outperformance that we've seen in this index, which is on the next slide and I'll touch on, but also the growth in the daily value traded of tech stocks on ASX. So you can see this middle chart here is around sort of $50-ish million a day. A few years ago, it's now about 800 million to $1 billion a day of tech turnover on ASX. So the whole sector's just ridden up really, really well. Talking about performance here, there's a few squiggly lines here, but bottom line is that the tech index here has massively outperformed, not only the ASX 200 benchmark, it's outperformed the S&P 500, and it's tracked neck and neck with the NASDAQ composite this year. And actually, when we cut this yesterday, it was just in front. So it'll move around a little bit, but it's pleasing to see it has followed that sort of US market trajectory, if you like. And you can see everyone obviously rode down hard for those 25 trading days in February, March, when everyone started to realize that COVID is going to hit and it's going to be here for a while. And the All Tech Index rode down the hardest. It was down about 50%, but it's up about 130% from that low. So it's been a wild ride, but over the course of this year, there's been a number of new companies added to it. There's been significant market cap built on it, and we look forward to see where this goes over the next few years. There's an ETF that's been struck off the back of it on day one, and that's got a lot of fun in it already. So it's all pointing to pleasing and positive signs for us.
Seb, do you want to talk a little bit about the IPO plans? And I guess when you deal with owners, probably when you meet with companies, the first ambition is to list. And I guess what advice would you give to that owner, and what have you been seeing in the market?
Yeah, look, I mean, it's a varied response. I think what we've heard from Josh today is that the ASX is genuinely a contender now at that later stage VC round. But I think it's not necessarily for everyone. I think that really you've got to understand the ambitions of that company. Yeah, so are you looking for growth capital? Are you looking for an exit? What are your ambitions first? And then you match the source of capital to that. For me, the ASX, if we're talking about the ASX, is effectively the next stage of your journey. So you've got to buckle in and go for that next ride. It's not at the end of the process, if you know what I mean. I do tend to find some people think that's the nirvana. They've made it to IPO, and for me, once you actually get to IPO, that's where all the hard work starts again. So I think that's something to bear in mind. I think even though I was completely wrong in my prediction on VC earlier, I think venture capital is still a massive part of the process of growing tech companies. I do think our VC market here isn't as well developed as our PE market, and so as a result, we do tend to take some of our earlier stage clients across to the US. In the US, our firm acts for 170, I think it is, VC and private equity firms. So we actually have really good penetration over there if we need to. And it depends where you are on your journey. That might be appropriate. And then you might get to the stage where you are actually sort of bordering on profitability, et cetera, and you start looking at the ASX or another exchange. But I think we've heard today that there's not too many options if you're a tech stock and really want to be on a public capital market. So I don't know if that's 100% answers your question, but I think it's varied.
Yeah, and I think, well, I'll follow that on with a bit of a longer question for you. I guess in terms of the journey, if you walk through a little bit about the journey in terms of the IPO process, the timetable, some of the main issues that you see companies address, and then I guess once you list, what are those continuing obligations?
Yeah, look, there's a lot in that question. You're right. I think the starting point is once you've actually worked out that you are ideally positioned for an ASX or any sort of listing, I suppose, but ASX listing, it's then a matter of getting that right team around you. I do think that at the start, you've got to work out whether it's right for you. Obviously, there's people motivated by raising capital, et cetera, who might push you down that path. But I think you need to get proper advice sort of that is objective in that situation. So once you've made that decision, and if it's the right one, I think the next stage is you're going through a listing process that is not easy. There's a lot to do, producing the prospectus and the financials, et cetera. So I think the next stage for me is getting the right team around you. So, the right brokers, in my view, quite often joint lead managers is probably a better way to go to defray that risk that you're going to get the capital across. You do need a really good equity capital markets lawyer, and obviously a good accounting team that have been there and done that. I think the accounting side or the financials part of the prospectus is very, very difficult. It's very heavily governed by ASIC. And as a result, it's not easy to get through those hurdles. And I think that's not well understood. I think people think if you're audited, it's fine. It's just a walk in the park. It's not. As it comes down quite heavily on the quality of information and the forecasts themselves. So I think that they're the key elements that are important to get you through the listing process. And then once you're there, like I said, I think that's the next stage of the journey. I'm probably telling people what they already know, but that continuous reporting and the obligations, the corporate governance, a lot of tech companies are really good at the IP and the product. And then what we find is that trying to put a corporate governance and an infrastructure around that is actually really tricky and costly. So I think, you just need to be prepared for all of those elements.
I think it's a good, so if I look at some of the fintechs that I'm working with, again, typically they start off, they're 10 to 40 people. The culture is very strong. Then they start to build and they start to think about listing. And I guess the hard part is keeping that quality of people all the way through as you're starting to grow. I think governance is an important one because I think people don't understand the continuous disclosure requirements. And I think if you look at a lot of the fintechs, they start with issuing a lot of options, and so that accounting for those, and I guess the going concern piece in terms of how you become profitable. So, so if I take a step back, I think you're right about, appointing the right people and starting the process a bit early. So a lot of the fintechs I work with, they probably don't have to be audited now, but I'm working with them just in terms of improving controls, improving financial reporting, just so when they're ready for that particular point, they can actually go through the prospectus practice. Because if you've never been audited, to then decide that you're going to list, which I'm working on one now, and they're finding it quite difficult.
Well, that's a really good point. I think you need to be prepared. The market is always open, but there are better times to be entering the market. And so most people think you can list quite quickly. It's minimum 5 months, really. And if you can do it quicker than that, good luck. But I think that realistically, you need to be prepared. If you can get those sort of fundamentals out of the way, your corporate governance, your audit, et cetera, so that you're ready to press the button on just the prospectus side of things, then that's the downside easier.
What we say to companies, and you're right, it's an intense journey, that sort of 5-month listing process, but the preparation to listing is key. And we have relationships with companies that are thinking of a listing quite far advanced in the future, and there's lots of forks in that road, and as you say, it's not for everybody and things may change. But if you are seriously considering about it, sort of as you get closer to the point of pulling the trigger, actually practicing being a public company while you're private, learning about the continuous disclosure obligations. If you make a mistake as a private company from a public perspective, there's no downside there, and it's far easier to learn as a private company than trying to learn as a public company. So we really encourage companies to try and practice it before they actually are getting up to it. And one of the reasons why the slide's up at the moment, that target market of around sort of valuations of $100 million plus, is really coming down to what you were saying before, Tim. You can list on ASX quite early, right? And that works really well for a junior resources company. But it doesn't work quite as well for a small tech company with a small founding team, who are still building out a product, finding a market fit, etc. And there's a couple of risks. There's a lot of risks there actually, but the biggest one from a governance perspective really is that the CEO of that business will be expected to be the face of the company and out in the market. And when you're still working on a product or trying to find a fit, actually asking someone to take, in aggregate, sort of 20 to 30% of their year in actually being a listed entity is a big ask. And so, we like to encourage companies to, have a few runs on the board, have a bit of a defensive moat from a product and a revenue perspective, and they're going to have a much better start to public life. So, sometimes it doesn't make sense. Like, our role is obviously to grow the capital markets, but we would rather see companies come in at the right time. And we actually spend a lot of time giving companies advice that actually, we think you're not quite ready, try, one more private round, try a pre-IPO round, and just get a little bit more robust before you come. Not everyone listens to us, but for those that do, that's our best advice that we can give.
Yeah, that's good advice, because I think, again, typically the owner is very dominant in the discussions, and so we've run a few scaling up workshops, internally for the fintech sector, and just getting the owner to hand over some of the control to the right people to manage the accounting process, tax process, governance process, is a key learning from my perspective on the growth journey. And then I think they're a lot more ready to actually list, because I think if you do it too quick, one of my clients has been taking 3 years, so that's probably a bit too long, but I think they continue to try, and hopefully they'll get there this year. So Josh, do you want to talk a little bit more about sort of the IPO process? I think you have a few more slides.
Yeah, sure. Yeah. So the last thing to touch on this side is really, so what does all that mean? And we sort of say, think of ASX as an alternative from a Series B raise and beyond. That's when it starts to sort of make sense for companies. We've touched on this slide a little bit. This just sort of shows sort of how ASX compares in the light blue at the top right there versus sort of other major exchanges around the world to get into those benchmark indices. And as you can see, our barriers to entry are very, very low, particularly the further to the right you go. S&P 500, $11 billion, $35 billion to get into the NASDAQ 100 these days. And as I said, it's that passive money which you start to attract when you're in these, and you get it at a far earlier stage here in Australia. So it's a big pull factor.
Is it worth just making more of a point on that? So with those lower threshold indexes, you're getting those global fund managers to invest in them.
Exactly.
Yeah. So I think that's the key point there. It's an index that allows you to have that global access to capital as well as the local, which I think is massively powerful.
Yeah, so there's a rough split of it for the 200 is around 55% of the money that's invested in the ASX 200 index is domestic Australian money, and the other 45% is international funds. And I think off the top of my head, about 50% of the 45, if that makes sense, is US institutional money. This piece here sort of just gives people, there's a lot of information here, sort of indicative sort of valuation expectations, if you like, for software companies, adjusted for size. So the top here is market caps of less than $1 billion. The bottom half is $1 billion plus. And you'll see that actually ASX stacks up very, very well, if not better, than a lot of its peers around the world. So, median sort of forward price to sales is about 5 times for a software company. Some are significantly higher, some are significantly less. There's never guarantees in this, but just to give people an idea, that's sort of where it's sitting at, a little bit lower when you run it by EV. But people talk about valuations, potentially being better elsewhere. The data doesn't necessarily support that. The fact is, you can get a globally competitive valuation here in Australia, and there actually is an argument. Although the tech sector has been growing substantially in the last few years, you still can attract scarcity premiums here in Australia. So, you know, like every good founder, you need to weigh up all your options and do your due diligence on everything, but this just sort of goes to show that we actually do stack up very, very well. Is it worth me running through listing criteria, guys?
I doubt it. I think it's probably too much detail.
It's in the weeds?
Yeah, I think so.
If you want to talk about that, you can come and see us. Last sort of slide from me really is just sort of brings it all together and sums up, you know, why tech founders should consider ASX, and these sort of points hopefully have all been covered through here. An alternative to that private financing, the valuation piece we've spoken about, that early index entry to institutional money is key here in Australia. You can get liquidity for yourself and early investors. And the last point, which we haven't touched on, is we're actually a single main board here in Australia, and that's really, really key. So a lot of other markets around the world run a main board and they run a junior board. And junior boards, you know, have a lower barrier to entry, which is fine, but more importantly, a lot of mandates don't necessarily allow that institutional money onto a junior board, and there's a progression piece. You've got to get off the junior board. Whereas in Australia, you know, if you're listed as a company with a market cap of $100 million post money, you'll start to attract some small cap funds here. But as you grow and hopefully as you succeed, passively you will start to attract that institutional money by default as you grow. There's no sort of progression, demotion, etc. That's a really, really key point. And then there's just a happy snap here of last Friday's listing of Nuix, which was our largest tech listing on ASX ever. So really, really pleasing by cap raise, I should say. And hopefully that record doesn't last for long, but they've obviously had a very, very good start on Friday.
Good. So Seb, I think you have just one or two slides to wrap up from a BDO perspective.
Yes. Oh yeah, the shameless plug that we are the #1 for IPO, I think 15 years in a row now. So we thought that was important to let everyone know that. No, but seriously, it's an area we focus on really, really heavily. Not only locally, but we are driving some of those initiatives globally with the BDO team. We do see the ASX just a massive opportunity for companies to raise capital. So, you know, the fact that we've done that for so long and so many, we thought was important to put up. That's probably a point to make there.
Okay. I guess just before we close, I guess in terms of any last minute advice to the fintechs that are out there listening, in terms of advice as they head into 2021, in terms of getting ready, I guess, for listing, any final thoughts to the fintechs?
Look, from my perspective and the exchange's perspective, if you are considering listing, come and see us early. You know, we can give you sort of an assessment on your business, you know, where we feel you're at, whether we feel there will be sort of institutional interest. We can introduce you to a lot of people in the intermediary community, and you know, forming a relationship early actually helps sort of build a relationship, and as we see you grow, we can help you at various stages along the way. So my advice is it's never too early to have a conversation. You know, that conversation may be actually, it's not time to list. Yeah. But you know, we can certainly help you on that journey, and we're very happy to have conversations with people from, you know, an early stage right through to, you know, sort of large Series D, E rounds, etc.
So, any last?
Yeah, I think the key message for me is that you need to get the right advice. Like tech companies, growing companies always need capital. Need to get objective advice. I do tend to find there's people there who would give advice based on what is best for them. So get objective advice, you know, make sure that you've actually got the right team around you, get prepared in advance. So I think those things are really important. Even if you're not ready for listing yet, you need to start that journey. Even if you're just looking for venture capital, local private equity, etc., you'll still need to have the right corporate governance. You need to have the right set of financial regime around you. So you need good advice regardless. I think that's important.
Okay. Well, that brings us to the end of the discussion. Thank you, Josh and Seb, for your valued insights. I'm sure you all agree it was a great session. As a reminder, the slides and contact details will be made available. So if so some of the slides that we with a lot of information you can read in more detail, and then obviously you can get a hold of either myself, Seb, or Josh. So that brings us to the end of our Fintech Friday session for 2020. We'll be relaunching again next year from February. You see on your screen now the details of our next webinars. The first one that we will be having is on RegTech, and we'll be having Deborah Young, CEO of RegTech Australia, and Lisa Schultz, founder of Verifier, on that particular webinar. As I just mentioned, we'll be sending out the slides after, and if you can please fill out a feedback form once we close the webinar to improve our webinars in 2021, that'd be great. Have a great holiday season and see everyone in 2021. Thank you very much. Bye.
Thank you.
Thanks, guys.